by $156 billion as commodity prices slumped and short-term volatility spiked. According to the latest PWC annual mining report, the world's top 40 miners all reported declining revenue and lower profits. The report says this trend is expected to continue well into the year. And it's not been business as usual for many mining companies, with falling commodity prices putting pressure on their traditional operating models. Cost-cutting measures have been the order of the day, and this includes a reduction in capital expenditure. Although strong dollars help cushion the impact of falling commodity prices, very few mining companies are showing growth. Now, for more on this story, we're joined by Andries Rossouw, Mining Director at PWC. Welcome, Andries.
Hi, good.
I suppose 2015 is not going to be a much better year.
Well, we hope it's going to be better, but it's going to be another tough year. The reality is that some of the cost-saving strategies that mining companies have started implementing earlier, 2013, 2014, are starting to pay off. So we've seen a reduction in costs despite an increase in production, which is positive. Reality, though, is that a fair bit of that reduction in costs related to the weaker local currencies. We've seen the rand weakening, but equally so the Australian dollar in Brazil, in Russia, and India. The weaker oil price has also softened the input costs relating to transport, and that has certainly helped the industry.
But, okay, it sounds as if things are beginning to stabilize. But there's one caveat. The US is going to hike rates. Won't that put a bit of more pressure on commodities?
Well, the US will hike rates if economic growth increases, and growing economies will support the mining industry. So in the longer term, there's certainly still growth in demand expected. But in the meantime, in the shorter term, we are looking at a fairly bearish outlook on commodity prices.
But what about India? Many people seem to think that India is going now on a huge infrastructure drive, and that may just save mining the way that China did.
I think you're right. The growth in China is tapering off on the infrastructure space, but certainly still growing in the consumer space. But infrastructure growth in India, in Africa thereafter, will support commodities in the longer term, not in the near term. India, about 280 million people still need access to electricity. In Africa, that number is significantly higher. So there's certainly scope for massive infrastructure expenditure. We've heard what they said at the WEF in Cape Town. Whether that expenditure will be incurred in the near term, unlikely, I suspect.
In the near term, cost-cutting is likely to continue, isn't it?
Absolutely. We've seen 20% reduction in capital expenditure by mining companies. They're in survival mode at the moment, so there's very little long-term investments planned, and it's really tapering off of the investment decisions that were taken in 2008 and earlier that's reducing the capital expenditure now.
Do you expect, with this downturn we've seen, that usually leads to a bit of dog eats dog, do you expect a lot of the smaller players to fall by the wayside?
I suppose that will be the case, as is normally the case. The reality is that lower margin producers will suffer. I mean, the big companies are looking at their lower margin operations and they're cutting those out. And we're seeing retrenchments globally and locally for that matter.
That was going to be my next question. The biggest loser here is the worker, isn't it?
Well, I think the reality is that mining companies see retrenchments as the final last resort in terms of cost saving. They cut capital expenditure first. They look at optimizing productivity with the resources that they have. So retrenchments are really the last resort.
How long does it usually take for mining to come out of a slump like this? Because, you know, a ship takes a long time to turn.
It does take a while to turn. We've seen a very long uptick in the cycle in 2000 to 2008. We certainly hope the downturn doesn't take that long. We've had a double dip, and we hope that it will recover sooner rather than later. Dip? Sorry, after 2008, we saw a significant decline up to 2010, nice pickup up to 2012, and now we've seen the second dip in commodity prices following 2012.
When you say the long term, we'll see some growth come in again, that should be natural. But when we say long term, how long are we thinking about here?
I think in excess of 5 years is where we'd like to see growth coming through again, and that's just natural for the cycle, I suppose.
So that means that mining's contribution to GDP is going to remain low, and countries that depend on exports of commodities are going to have to find other means.
Well, they might not be able to find other means in the short term. Commodities still play a significant role in a lot of countries. Countries are looking at better ways of harnessing the value of the commodities. Local beneficiation is something that's looked at. Extra taxes are looked at. We've seen countries actually reducing taxes in order to support the sustainability of their mining operations, which is quite promising. So we hope that the role played by the regulators will be more positive rather than negative.
This beneficiation drive that everyone keeps speaking about, how viable is it, given that we have such a big lack of infrastructure and a big lack of capital, especially in Africa?
You're right. One needs to be very careful for unintended consequences. In Indonesia, for example, a total ban on nickel exports, unbeneficiated nickel exports, which meant that the mining thereof just completely collapsed. Locally, or a bit closer to home, the DRC has added significant royalties on copper concentrate exports. Zimbabwe is trying that as well. And the risk is that will kill the industry by trying to tax it to death.
Bad news all around, but things do improve. Thank you for your time, Andries Rossouw from PWC, Mining Director there. Now, state-owned transport.